All right, so I'm Trey Stewart, candidate for an MBA, currently in BUA 651, which is a finance class in the UMaine's online graduate program. This is my portfolio project. Here's my ID. Hopefully you can see without any other information on there. So I'm going to go over real quick my portfolio project that I did for BUA 651. We had a portfolio comprised of about $100,000 worth of assets. Ran it for about 3 months, a little less. And the goal was to hedge out any, hopefully, any risk with a pairs trading technique with long and short positions and beta neutrality. So I'm going to jump right in here because I don't have a lot of time. So here's basically an overview of what the portfolio looked like. You can see I had a little bit more in my short position. And originally it was I wanted to kind of push my beta a little bit negative to hedge against market downturns. I'll talk about that later. If at any point something seems unclear in this video, I guess I would refer back to here. I'm not going to be going through what the beta values were and all the details and how much I put into each one. I think that's kind of a waste of time. If you're really curious about that, you can come and check it out here. Know that my net dollar exposure was negative $7,782. My net beta exposure was about negative 0.1. Those are really the important parts right now. Here you can see the breakdown of my long position. So I had SPY, Lowe's, Bayer, a gold ETF commodity to cover my commodities, long-term bonds and TLT, and a foreign equity, an S&P. So had a little bit of everything in my multiple asset class portfolio: foreign and domestic equity, real estate, commodities, currency. Here's my short position. Again, you could see healthcare, domestic equity. In the form, these are all ETFs. They're all pretty well diversified already. Diversified out a lot of the risk. XLV, healthcare, XHB home buyers paired with the real estate, the lows. XME, minerals and mining ETF paired with gold. FXB, which is a British pound ETF, the currency, and FXI, which is a top 25 index from China, also an ETF. So let's dive right in here to some of the analysis of the pairs trading. So you've got Bayer paired with the healthcare sector, basically. You can see that they both underperform the market. The reason I chose Bayer was because Monsanto, which is an agricultural kind of chemical company, recently submitted a proposal and their shareholders approved a buyout of Bayer. Typically when you see that happen, it means short-term gains for the stock that's being, or the company that's being purchased, and short-term losses for the company that's doing the purchasing, sometimes long-term losses, depending on how it goes. So I thought this would be a good one to go long on, considering that it's kind of a short-term portfolio. So right around here is where you can see where the shareholders approved it, and it shot right up as I kind of anticipated. So it outperformed the sector. The sector remained pretty constant. I think it's probably going to remain that way for a while, at least until we figure out what's going on with Obamacare and what that's going to look like under President Trump. And I'll talk more about that later too. Here we have Lowe's paired with home buyers. Lowe's pretty blue chip stock. This sector in 2008 in the housing crisis took a pretty good hit, And Lowe's, for instance, was trading at about $13 per share. Now it's up to $75, and can be regularly found beating the market sector for this particular asset class. Same deal with home buyers. Since 2008 hasn't really recovered to the level that it was once at. I think that kind of goes to show the sentiment of that market from 2012. It started to take off again a little bit, but it's now trading between $30 and $35 pretty consistently. And I think this will continue. These trends will pretty much stay constant throughout the holiday season, and at least in the short term. And I think I don't anticipate there being another big bubble in the housing sector like we saw in 2008, because that wound is so fresh for a lot of investors that they're pretty cognizant of what's going on over there, unlike the last time. Here we have gold, getting into the commodities now, paired with minerals and mining. So you can see here, minerals and mining kind of took off in November. This is one area that I did not anticipate this happening. This is right around the election. The election has a lot to do with the way my portfolio performed the way that it did. I was anticipating minerals and mining, that sector, to go down, because there was talk across the globe of strikes of mining workers, which I thought would hinder the market, at least in the short term. Would push prices down some. For the most part, that was pretty true until we got to the election, and then stocks across the board took off, and probably in response to consumer optimism of what a Trump presidency is going to look like for the economy in the U.S. and where our position is going to be in the global economy. So I think there's a lot more optimism now than there was before. Additionally, gold has been kind of hit or miss, mostly miss lately. It was one time trading at around $1,800 an ounce, or is worth about $1,800 an ounce, and is now worth around $1,150, and it's pretty much continuing to head south, at least for this year's performance. So GLD is an ETF comprised basically of the consumer sentiment around gold. At its high, it was trading at about $130, and now it went all the way down to $100, and now it's back up to about 110. So I think it'll probably stay pretty solid for right now, at least. Gold's one of those things. My grandfather raised me. He always wanted me to pay attention to what gold was doing, because it's a precious metal that eventually we're going to run out of and hit a critical mass of. I don't know when, but with technology, expanding the way that it is, I think that's a variable that we have to be realistic about. And so, anyway, don't want to talk about that too much. So, all right, here's where things get a little interesting. So S&P, which is the Chinese security petroleum and chemical corporation, paired with basically the top 25 Chinese stocks. It's an index. So you see here that FXI went down. Was kind of anticipating that, which is why I paired the two. S&P went up. However, my take on this right now is that I would be hesitant to really touch anything in China, particularly in Chinese energy and Chinese oil and natural gas. Reason being, you've got two variables that you really don't know what's going to happen with over the coming months. One's OPEC, and they're kind of hit or miss, and they have a huge influence on the market. And the other is Trump, and I don't know. The whole campaign, Trump, was talking about we're going to be more competitive with China again. So I don't know what that'll entail going forward. I hope it's something that's amicable for both countries and both economies, but I just wouldn't put a lot of weight or money into anything that deals with China right now. All right, bonds and 20-year bonds, and this is the FXB is British pounds. So here, all right, here's where you see really the impact of Trump. So right around here is the election, stocks take off, bonds take a major hit. All right, and this is probably one of the huge pitfalls in my portfolio right now. FXB, so my thought process was I could short FXB because this is a short-term portfolio, and they recently had their Brexit vote, which is a rather conservative move, but has put their currency on the global scale kind of in flux. So the FXB has gone down basically, and I thought I could probably bank on that happening at least for another few months, so I shorted it. Conversely, I thought the U.S. bond market would continue on its trend of going up, or at least remaining, competitive, and was not the case. Right around here, November 8th was the day that it all went south for this portfolio. And finally, the Mac Daddy of them all, as someone I know refers to it as, SPY. This has been a huge workhorse in my portfolio, given, again, you could see it very clear as day right here. The election, boom, takes right off, heads northeast. And I don't really see any signs of that letting up, at least through the holiday season. So I'm not going to make any real long-term projections because come January and come Trump's inauguration, you never really know, I guess, where he's going to go. But I'll talk about that a little later. And I had a long position on SPY, which played out really well. So key problems that I had. All right, so the first one, as you probably saw from the first slide, we were supposed to have about $100,000, and I was off by about $7,000. That was actually a spreadsheet error. So that was, and I didn't catch that for a few weeks, which threw off my. I didn't take it into account at all, and I was flipping through one day, and I realized that the numbers were wrong, and it threw off my weighted beta average by a bit, and pushed me even more into a short position than I wanted to be, particularly as I saw what was kind of unfolding. So that kind of stunk. Lesson learned there. Always double check. So this is one thing I didn't really get in the beginning, the pairs-based trading concept, and we had to formulate this portfolio at the outset of the course, and I really didn't have any experience with portfolio creation or design or techniques or anything like that, and so I'm not really even sure what I was thinking in terms of what pairs-based trading was. It was simply a rookie mistake, and I kind of threw a couple things together that really didn't make sense. A good example of that would be bonds and a currency that didn't belong together. Additionally, I thought I could kind of pair SPY in the long position with pretty much whatever, and I didn't even really have a pair for it as it turns out in my short position, so that kind of threw things off a little bit too. Lesson learned there as well. Foreign risk. So another term I really wasn't familiar with, but the concept of hedging out foreign risk and country specific risk is something that I didn't really understand in the beginning. So you'll see kind of my foreign stocks are just kind of all over the place, like Bayer's German-owned company. Obviously, you've got the pound that I shorted, and you got the Chinese stocks just kind of thrown in there helter-skelter. There wasn't really any rhyme or reason to it, and I go looking back at it, I definitely do things differently there. And another thing that I didn't really factor in at the beginning because I just wasn't paying attention to it. I think I was kind of short-sighted at the creation of the portfolio, just looking at the project and just kind of trying to throw something together was the expenses associated with Trey. So one of my ETFs, the FXI, the Chinese ETF, has an expense ratio of about 0.74. Which is higher than I would want it. And looking back at it, if I would have realized that now, then I probably would have kept that one out of the portfolio. So let's see. So the overall outcome, total return was negative 1.07, so didn't have to pay taxes. I guess that's a good thing, but I lost money. I guess reason being, and you could really see it here. Gold continued to tumble, but bonds killed me, and gold here too. This was a good one right here, but so you can really kind of see it. And then, like I said, SPY was a total workhorse. Lowe's was great. Bayer ticked up a little bit. Healthcare remained kind of steady. This S&P was okay. Like I said, I don't know if I'd touch China right now with Trump, about to take in office. So anyway, like I said, my total return was about negative 1%, which actually correlates pretty well to what my beta value was of negative 0.01, given that it's a $100,000 portfolio, or ballpark $100,000 portfolio that was off by about $7,000. Weird. So I'm not shocked at how it played out. I just didn't anticipate right here the Trump effect and what that would do. And I think if Clinton had continued on the path that she was on, or at least the polls had her at, back in September, and it ultimately went on to win the presidential race, I think the trends would have continued, and I would actually be sitting pretty probably up 4 or 5%, which that was the pathway that I was on. So it's got pretty historic implications for both the country and the economy and finance, and I think it's kind of unprecedented. So it's really hard to factor in what that's going to do to your portfolio, given that this election, you'll hear political analysts say, and financial and business analysts say that they've never seen something like this before. So it's hard to prepare for it. Technology, information sharing, I think that's going to be something to keep an eye on, because as we know through taking this course, Eugene Fama theorized that asset prices and basically markets respond to all information that's available to them. So as we transfer information quickly, I think you're going to see prices adjust faster in the future, and I think you're seeing that even now, right after the election, boom. Everything changed. So finally, the last big takeaway for me is in my personal life, I've found that I've been able to apply a lot of these lessons and techniques, and just kind of things that you tuck away into your brain, and then you find yourself considering them in general life. And for me, in my personal and professional life as well, going into the Maine legislature, and starting off there, and being able to look at a spreadsheet and actually know what's going on, and what the finance technique that the state of Maine is using in some areas, and where some inefficiencies are, and how I could be an asset to the state and the taxpayer. And I definitely chalk that up to this course and this this application and project. I've learned a lot, just basically by failure, which is kind of cool and interesting, and really appreciative for the opportunity, and glad I had the chance to do this and to learn the way that I did, and that's it. So great.